Okay, so hello everyone, and first of all, thank you so much for being here. I mean, you could be watching 50 Shades Freed next door, and I wouldn't blame you. And I don't promise we're gonna be as much fun, but we will do our best. So I wanted to ask, like, how many people here are hardware entrepreneurs or investors, but I wouldn't be able to see anyway because of light. So I would assume some of you hardware entrepreneurs and investors, and this talk is kind of for you. Or maybe if you're not a hardware entrepreneur yet, we're gonna convince you by the end of this talk, but it's a really good idea to start business in this area. So I'm Valerie, this is Ashish. We both work at Grecian Robotics, and this is VC firm that's been investing in like smart hardware of all different shapes and sizes for the past almost 6 years. So we invest in hardware, in robotics, in IoT, in commercial space, and really everything in between. And my background is mostly operational, in particular like marketing, communications, business development, and prior to that I was a software engineer, and now I'm kind of combine all this, hopefully, when I'm kind of mentoring the early stage companies in our portfolio. And I guess I'll give Ashish a chance just to tell a little bit about his own background.
Thank you so much for having us here. It's a pleasure to be here, and I've been kind of overwhelmed with kind of seeing the excitement of entrepreneurs and early stage startups that I've met over here so far. And personally, I've been coming from an engineering background, computer science undergrad, worked for Yahoo for a bunch of years, lived in India, China, US, started a couple of my own companies after living in China. Both of them failed, so I understand what it takes to build a failed company. I haven't built a successful company, so I don't know. After that, I kind of went back to business school, did a bunch of stints in marketing, ran M&A for a large company, and then currently working in early stage investing. I think it's been very interesting to see how things have changed over the past 5 years, like how building a software company has become easier over the past decade because of AWS, compute, network, and storage resources have become really, really cheap. But similar transformation is actually happening in on the hardware and robotics side, where you start seeing after 2 or 3 decades of a lot of development that's happened in various fields have allowed different, a lot of these technologies to come together, and it's 3D printing, prototyping, supply chains in Shenzhen have become very efficient, and all of these factors combined together have made it very easy for people to go out and start building hardware startups very, very quickly on that side. So we are very excited, and we have met with some very, very great entrepreneurs here, and looking forward to kind of talk about what we think you need to in terms of building a successful business from a VC perspective, which is, of course, not always the right perspective, but whatever it is.
I mean, it's definitely like our perspective, what we are looking for when we make a decision whether we want to invest or not in a hardware startup. And I think, it's a really great point. I mean, when we just started Christian Robotics, like back in 2012, everyone thought we were crazy. I mean, everyone was still excited about like Facebooks, games and mobile apps and stuff like that. And they're like, the hardware is like too expensive, too long, too complicated. And I think like fast forward, yes, hardware is still hard, and we're definitely going to be talking more about it. But exactly as Ashish said, the number of startups, being launched in the space, both consumer and enterprise, and we kind of invest in both, and number of investors in the space, number of funding rounds, it's been just growing exponentially, throughout the past few years. So I think just really like, maybe we can start with like what is the most important thing for you? What are you looking for, in a sort of in a hardware startup? And this is like one of the key indicators for you, like this company has a great chance of being successful.
So I think the answer, of course, generally people will tell you like it depends, but I think every time you're pitching an investor, they are in their mind trying to understand what is the type of business that you're building is the closest business that they have seen, and they are trying to basically kind of like in their mind have a lookup table and trying to compare that with you and see and put you in that bucket. That's why they're asking like, hey, are you a consumer business? Are you an enterprise business? Because they know that if you're a consumer business, then there are a list of questions that I'm going to ask you about your customer acquisition cost, like how are you going to acquire customers? What is the lifetime value of the customer? If you're an enterprise customer, people are going to start asking you about your enterprise sales cycle and things like that. So I think I will talk specifically from the consumer perspective, at least. A couple of things that people generally want to see, at least in a Series A company, that's where we most of the time invest, is that you have actually built a product, you have a ready prototype, or you have actually delivered a product, and you have some demand that you can show in terms of saying that, hey, the problem that we assume as a company is a problem that somebody is willing to pay for. And normally people don't like to see one-time hardware sales. We definitely want to see hardware plus subscription of some sort. Maybe not today, but at least a path where you can start charging for a subscription model going forward. Because if you're doing only like one-time hardware sales, it's very difficult, because it's, as you look at the stocks of GoPro and Fitbit, it's very difficult to predict what are the number of units that you're going to sell in the next quarter. Whereas subscription revenue has a lot more predictability, because you can look at metrics like churn, and those type of things can help you understand, bring more predictability to your revenue streams.
Yeah, I think it's a great point. And just in general, I think the interesting thing that's happening with consumer hardware is we all remember, Oculus and Pebble and Ouya and Nest and Dropcam, sort of all the success stories. And I think at least at the beginning, the Fitbit and GoPro, they were also success stories. But at the same time, we clearly saw this dynamic of what DJI did to a lot of US-based consumer-drone kind of companies, and not just consumer-drone companies, right? I mean, what Xiaomi basically did to the market of wearables, what Apple Watch did to the market of wearables. So I think there was a lot of initial excitement, and all these M&A deals, they sort of definitely added fuel to the fire. But I think fast forward, in 2018, like from our point of view as an investor, our requirements and our sort of demands, what we expect from a consumer hardware startup, they became much, much higher. So first of all, I think, and exactly as you said, thinking about the way you prove to us that there is an actual demand for your product, like we don't care anymore about Kickstarter campaigns. We don't care anymore about Indiegogo campaigns. Even if you're gonna if you would come to me in 2012 and you would say, we raised $1 million on Kickstarter, I mean, it would maybe at least pique my interest. Like today, no, not anymore. And let's be honest. I mean, it's great. It's better than nothing. But it's like if you hire right marketing firm or right PR firm, I mean, you're gonna make a successful Kickstarter campaign, more or less, especially if it's a consumer-facing hardware business. It's just really there is almost a recipe you can follow to make a successful Kickstarter campaign. At the same time, if you for some reason you are not able to do that, and you're gonna have a failed crowdfunding campaign sort of in your portfolio, this is not gonna look good. It's not a positive signal anymore, but it still can be a negative signal. So you have to be very careful, because when I see a founder who wasn't able to pull off successful crowdfunding campaign, even though I know how much easier it became, that's definitely a red flag for me. So I think maybe we can also talk a little bit more, just to switch gears, like what are you thinking about, like what are you looking for in enterprise hardware and robotics startups?
So I think on the enterprise side, I think, so I'll take one particular example, specifically in this case is the warehouse automation. The idea is that basically as labor is becoming much more expensive and the demand for e-commerce is increasing, the Amazon, of course, is pushing the game on automation, where they are basically trying to reduce the OpEx of serving a particular order. And every other major retailer / grocer / whatever you want to call them, who is operating warehouses is feeling the pain that they have to kind of do something on that side. Amazon actually acquired a company called Kiva Robotics back in 2012, which they rebranded as Amazon Robotics, and they took away all of those robotics. They stopped selling to other customers, like the likes of Walmart, for example. And in that particular case, that created kind of like a void in the market. And now everybody's trying to basically build some type of robots on that side. Now, if you think about in that particular area, we have seen so many companies where people are trying to basically build a strong technology. The technology solution might exist, but they either lack a strong BD person, or either they have a pilot with one particular customer for past 1 year, wherein which they are not even able to get scale even within that customer itself. So what we are looking for specifically in those areas is like somebody who has kind of like at least deployed at scale, even within one customer. I mean, most of these companies are kind of like get stuck with the NRE revenues for less than like between 1 to 5 million or maybe up to $10 million of revenues, depending on what type of pilots you are doing. But like building that type of pilot in itself is going to get picked interest from the VC community, and then people are going to start talking about like, hey, what technology you have, what actual problem you're solving, because if you don't have a good sales and if you have built a good product, good luck trying to raise fundraising with that business idea.
I think you raised kind of a couple of great points. So I think first of all, it definitely changed. Like again, back in 2012, 2015, if you would come to me and say like, we have a pilot with Walmart, I would be, oh, okay, that's nice. But I think these days, like, and specifically, I mean, yes, for housing automation, and I was looking specifically like for robots in retail, like front-facing, customers, if you other different ideas. And it's like at one point, I had basically like 7 to 10 startups on my desk, and they were all telling me about, we have pilot with Walmart. I'm like, people, like, this is not going to happen. Like, basically, the dynamic we see is the negotiation power disparity, so to say, between this big enterprise customers and between you as a startup. It's just so negative, and it's definitely not in your favor. And what we are seeing repeatedly, and of course, we're not going to name any specific names, even like one of the, like, you all know the startups, they raised like 30, 40, 50, like they all raised significant rounds of capital from top tier Silicon Valley VC firms, and they just keep bleeding to death, through the investors' money while being in these endless pilots with these enterprise customers. And guess what? Walmart can afford to be in a pilot with you forever. They are not in a rush to move forward. This is your problem. And they can decide to pick one solution over another, or they may not decide. In the end, they may even decide like sort of a build versus buy. They may just in the end figure out, we're just gonna build it ourselves, we're just gonna copy it or, whatever. So I think this is, very, very important thing to understand, like our requirements as a hardware investor, they just became much higher, both for consumer and enterprise businesses throughout the past few years. And I think another great point you just mentioned is, and it's kind of embarrassing because it's roughly the same stuff I've been saying at these conferences since 2012, and it's like, it's still relevant. Like, what is the problem you are solving? And I think it might be even more relevant for hardware and robotic startups just because it's such an exciting stuff. Founders I meet all the time, they're like, we're building robots, like we are amazing. And I'm like, yes, you are, and I love robots as well. I mean, it's a cool, geeky thing to do. But the customers don't care. I mean, they just want their problem to be solved at a reasonable price point with a meaningful ROI, especially in enterprise space. They kind of don't care whether you do it using robots, using humans, using, something else, right? And I think it's just very important. Like, usually startups die not because there is something wrong with the technology. Like, I usually expect almost by default that you will be able to figure technological side, out just because you have a talented technical team. But actually being able to talk to customers and, enterprise sales cycle is a bitch, it's like usually at least 6 months. It can be into a year, and unless you have someone on your team that actually like done this before, and I know you have this capability, that's just simply like not something you can add later on.
Yeah, I think one of the great points that Valerie mentioned about is the concept of ROI, right? I mean, if I'm Walmart, right, I'm talking about currently I'm spending X amount of dollars on solving this problem. Like when you come in and you want me to do a capex investment of Y dollars in the beginning, I need to understand like what am I saving? Like for example, if I'm putting $10,000 for this problem and you're asking me to put in $50,000 and the solution is going to save me $5,000, the ROI is 10 years. I mean, the technology landscape is changing every 2 to 3 years. Who's going to invest in ROI for 10 years? So if you have an ROI which is more than 18 months down, even that is becoming very difficult for people to prove to an enterprise, like, hey, here is the real solution where you can get an ROI in 18 months. And even that is very difficult to sell in certain cases. And I think when you think about kind of from that enterprise side of things, Valerie, what do you think kind of specifically, let's talk about specific areas like consumer hardware. What do you think kind of, how can startups compete with these larger companies like Amazon, Google, because every time they do a developer show, like they kind of end up basically killing many startups.
Yeah, and I think, you all guys, especially hardware startups among you, like, what happened to Nucleus and then what happened to Amazon Show. And I think it's actually a very great, it's a very good example. Like, be careful how you deal with strategic investors. And that's sort of like topic for another conversation, a separate thing is like, it's a very tricky balance. Like, I can fully appreciate that you want to partner very often with companies like Amazon, Google, Apple, you name it. And there is like, I understand you sort of feel like there is a lot of value to extract, from these guys. But also like you have to be very careful in the sense of like how you manage negotiations with them, how you manage like information disclosure, how you manage terms. And I think also like financial, purely financial investors like us, like we are also like very conscious of this dynamic. And even like among some of our portfolio companies, we saw saw some like weird and tricky dynamic happening with, strategic investors asking for some, unreasonable non-market terms in the round and stuff like that. Like not all corporate VCs created equal, not all strategics created equal, but I would definitely recommend like do a lot of due diligence, like talk to founders of portfolio companies that accepted money from this particular strategic VC in the past. Try to figure out like how they behave like in the, meetings of boards of directors, how they support portfolio companies, and stuff like that.
I think you kind of answered the question on that side. I think the one specific point where I want to highlight a little bit more is how do you deal with strategics, right? Because the question is kind of when you are talking to a strategic and somebody comes and says like, hey, this large company wants to put money into a seed stage company. I'm like, you are a seed stage company. Your technology is not even ready. And why would a strategic want to put money into you? It's fine. They want to help you a lot in distribution, but you have to also understand on the other side that what you are doing is actually going to restrict your distribution, right? Because in certain cases, some of these, of course, I mean, entrepreneurs read a lot of these legal things, but at the same time, some of the things that they put in these things is like request of first refusal or like request of first negotiation, right? Like, so for example, if you're going in the next round and try to bring in some other capital or trying to basically sign a distribution deal with their competitor, they actually have control or a strong say to basically deny you that privilege of going with their competitor in that case. So as an early stage company, you should be very careful of taking money from strategics at seed stage or Series A on that side, depending on the industry that you are in.
Yeah, I think it's a very good point. And I think maybe just to switch gears a little bit, we sort of made this like deep dive into like the intricate details of, how to, build a successful, hardware business and enterprise space. But I think just to make a step back, and I think in general, and it may sound odd coming from a VC, but I think honestly, I think this is the first question you have to ask yourself is like, are you sure you want to raise venture capital? And I think very often, like founders, especially here in the Bay Area, they tend to be a little bit myopic, and like, we are all so caught up in reading these TechCrunch articles and stuff, and like we sort of will feel like it's a holy grail, of your founder journey. Like we're gonna raise, I don't know, a Series A from Sequoia, Clarnell, you name it. And I think what you have to be like very conscious of is like, first of all, this is not the only possible, source of capital out there. Like by all means, no. And I think what's also important to understand is like, if VC rejects you, if like you come to us, we give you some specific feedback, and like we say, we don't think it's a VC backable kind of company, sort of a language you normally use. It doesn't mean you have a bad business, like not at all. And we tend to have this distinction like VC backable versus lifestyle kind of business. And I think very often founder, they kind of like, we perceive it in a bad way, like as if like we think lifestyle business, something is bad for them, but not at all. I think the key distinction here, you might build a very nice business for you as a founder, and you might get anywhere to like $5 to $10 million in revenue on an annual basis, and it's going to be like great outcome for you. However, like venture capital as an asset class, we are looking for very specific type of companies and for very specific types of outcomes. Like basically our main question is, will you be able to build $1 billion company out of it? And I think like maybe if you can just talk a little bit more, like it may sound like very obvious, but especially like when we talk about warehousing automation and many of these kind of enterprise markets, like market sizing is kind of not an obvious exercise at all. And I think this is like one of the main reasons we reject like most of the deals that come to us, not like without even talking about technology, without even talking problem, like without even talking about product, is like, is this market big enough? So maybe you can just elaborate a little bit more on that.
I think specifically on the enterprise side, I mean, everybody basically starts showing us like, hey, this market is like $30 billion. I'm like, yeah, but that's the total spend for every single thing that you just showed me. Can you just kind of like break it down into specific aspect of what you are doing? And if you are replacing something, what is the refresh cycle? So if you start digging deeper into those questions, you can very quickly see that some of the assumptions that the founding team had made on the market size does not exist. And the market size that kind of like started with like 10, 20, $30 billion turns out to be $500 million to a $1 billion or $2 billion market. And if the total size of the market in itself is like $2 billion, which is growing at like 5 to 10%, or even like even at like, if it's a mature industry, it might be growing at like 1 to 2%. So that in itself is kind of like very, very difficult to prove that. And it's very difficult to, even if let's say you have 20% market share, you're still going to be like $200 million revenue company, and that's basically making sure that everything else kind of like sticks. So that's why a lot of the time the VCs kind of like spend a lot of time talking about how big is the market on that side. So that's why I think you should spend a lot of time thinking about the market size also, because it's good for you to understand, like, if you're trying to build a company in that market, like, if the market in itself doesn't exist, then a lot of the assumptions that you've made or baked in going into spending few years of your life is very difficult conversation to have with yourself.
I think we kind of are running out of time and we need to switch to Q&A soon. So I think just to not even like wrap up, I mean, we just scratched the surface like of everything pretty much. But I think just to reiterate, like very important point that Vashish made just at the beginning is like, hardware, it's like, yes, we invest in hardware. Yes, we are looking for hardware and sensors enabled businesses. But as we already mentioned, Fitbit, GoPro, and all these other people, and like case of DJI and Xiaomi, hardware is getting commoditized very quickly across pretty much all the industries and verticals. And I think the mental exercise I like I really like to do with founders is like, let's imagine that I don't know, like your margin on like, it's safe to assume that in 3 to 5 years from now, your margins on hardware are going to be like next to zero. And let's imagine by default that everything you're doing, like regardless of complexity, can be copied in China in 3 days. And I know it's a gross oversimplification. And yes, let's pretend patents don't exist. In that case, how you still will be able to build a meaningful, viable, like reasonably defensible business? And exactly as Ashish said, really the magic and like the secret, it's really on a software side. And we can dig much deeper into the big data, machine learning, all this kind of stuff, like what we expect, from a successful hardware company to accomplish on a software side as well. But I think just broadly speaking, to summarize, like, first of all, be sure that what you are working on, it's a product, not just a feature. Then be sure that it's like you can build like at least a product line. It's not gonna be just a one-hit wonder. And then like answer my question, like how you will be able to make a platform out of it, right? And usually the foundation of the platform is really data. Like how you will be able to leverage your existing user base and everything you learned about the behavior of your customers and all the data you have collected to hopefully offer the same customers more and more and more and sort of offer them extra premium features and increase lifetime value and so on and so forth. So I think at this point, we should...
I'll just add one more thing. I think unit economics is an extremely important part of the business. I've met so many companies where the founders have no idea what the unit economics are, and they kind of like live in this world where like, hey, as we will get scale, we will be able to increase our prices, and we will be basically start able to hit our like gross margins, right? You have to understand that when you're competing with like, if your gross margin is 10%, you have to understand what that means. If your gross margin is 70%, you have to understand what that means, right? Sometimes the founders don't even understand the difference of gross margins. And I think I understand that you're a technical person, but spending time on understanding like how does your unit economics look like is extremely important for you to understand. Like if you are losing money on one unit, doesn't matter if you're selling 10,000 units, you're still gonna lose money. Like the principle of economies of scale is only gonna save you money as a percentage of certain things, but keeping that in mind is very important as you're building a hardware business.
So I think at this point, let's switch to Q&A. I assume there are people with microphones and maybe some people who want to ask us something, or maybe not.
Just real quick question. So I know you guys specifically invest in hardware startups, correct?
Hardware plus software.
Okay. So with that being said,
of both.
I was speaking to a friend of mine who has a hardware startup himself. I have a hardware startup myself. Still a project, but the thing that he was worried about is copycats. And what we were talking about, especially with his advisor, as far as creating a business model where there's some type of recurring revenue embedded within the hardware. That necessarily equated to a software aspect of his business. Now, is that something that can be seen as far as acquiring some type of VC money as more worthwhile than somebody that's just coming up with the hardware themselves?
Yes, the short answer is yes. Because in that particular thing, what you're doing is you're actually building the see, it doesn't matter like where the recurring revenue is coming from, right? The thing generally it can happen is twofold. One is either it's a software that is enabling some type of technology within the hardware where you're restricting the functionality, where you say like, hey, by default you're getting X, but if you do something else, we will give you Y, right? I mean, for example, if it's a security company that you've just video camera installed to capture the video feeds, and you only provide, say like, hey, I'm going to only provide storage for 1 day, but if you give us recurring revenue, we're going to store it forever, right? I mean, so understanding what is the complexity and where the recurring component thing is built into the hardware, I think that will be more important for me to understand.
And I think just to give a good example from our own portfolio, so we have a company called PetNet. And I think it's a great example because if you look at the business model, so like they build connected pet feeders. And like they have everything in place. So they have a connected pet feeder itself. They have like connected, sort of like separate bowl, and it's great because when you think about your retail presence, actually retailers prefer to deal with companies, as a lot of people here know, who have sort of a multiple SKUs, so that in sort of a, can just, deal with a single company and give like a whole range of products, especially on the consumer side to their own customers. But I think like the second part, they also like they have a subscription service. So basically when you have this connected pet feeder, you can also subscribe to their regular delivery of pet food essentially to your door, which is great because it's recurring revenue. They have amazing margin on this pet food and whatnot. And very important, even maybe like the most important part is like they collect all the data, and they have clear customer for this data, manufacturers of pet food, like the biggest players out there, Nestle and Mars and you name it. And they have a problem because they have no clue what kind of, who are the customers, the customers buy this food and that food, but they don't know age, they don't know geography, anything like that. And PetNet actually gives them a very clear picture: who are these people, where are they located, and and pet food producers, they are ready to pay like significant amount of money for this kind of data. So these kind of ideal combination of hardware, recurring revenue subscription, and also big and valuable data set that has clear potential in terms of providing it, selling it to existing big companies. I think this is kind of the companies we are looking for, especially in the consumer space. Are there any other questions?
Yeah, there's one more person in the.
Yeah.
Can you just speak out? Wearable tech is very difficult to build a company because if you come and tell me like I have better technology, it doesn't matter, right? I mean, the idea is like show me the traction. It's all about traction on the wearable tech side, because you tell me a category in which you are building a wearable tech, because most of the categories are overpopulated with like so many companies. Like if you've been to CES 2 or 3 years ago, you can just walk down the aisle and you can just type the type of stuff that they are, like everything from sweat to like breathing to like every single sensor that you are basically, that your body gives out. Everybody's monitoring that and trying to figure out what to do with it. So we are not sure. I mean, we are not very bullish on any other type of wearable tech company unless it's solving a big problem. Like if you're building something for elder care or for senior care, that may be interesting just because of the nature of the problem that you're trying to solve. But in that particular case, it becomes what traction you have and what is the complete solution. It's not about just one particular sensor that you've built. In case of clothing, do you have any inputs on that?
Sure. I mean, just to follow up on that. So I mean, it's poorly defensible, like extremely crowded in terms of competition. Like margins are going down. I mean, it's all commoditized. But I think it's like exactly as you said. I mean, it depends. Like, what exactly do you mean by wearable tech? I mean, to do fitness, trackers today is a very bad idea. There is essentially like no future there for a startup. If you focus on some specific interesting verticals, as you said, like elderly care, maybe like kids, some stuff like that, there might be something there. But again, you are competing against Xiaomi and Apple, and you name it. But I think it's smart clothing. Personally, I'm very excited about this space. But like I've been waiting for a long time already for it to happen. And I think exactly as Ashish said, it's not really about the technology. It's really, I mean, it's about distribution. It's about building out consumer brands. And let's be honest, I mean, we as end consumers, we are not the most rational beings out there. You cannot exactly sell to us. We are not enterprise customers. You cannot exactly talk to us in terms of ROI, It's like a lot of this is a kind of like intangible like fashion, fad driven. kind of a decision-making process. And I think, again, for a lot of the technical teams, it's exceedingly hard to like wrap their technology into the kind of a product that would be as appealing to end customer as another iPhone, basically. And if you're in a consumer electronics space, you are competing with Apple and iPhone. Customers expect the same, quality of design and the same quality of hardware and software as they used to, getting from Apple products. And if you're doing smart clothing, like you are competing with, Ralph Lauren's and Zara's of this world. Because just think about Google Glass, right? I mean, this is like there's a lot to study in this kind of example. I mean, technical company, and they just couldn't pull off something that we wear as a fashion statement. Essentially, I think there is just so much more that goes in building a successful product there, as opposed to just having great technology. So it's an interesting space. I think opportunities are still there, but it's so freaking hard.
I'm sorry, guys, we don't have any time for more questions, but please give a big applause to Valerie and Ashish.